In the last video, we talked about what credit is and spent a bit of time discussing credit scores and risk. In this video, you'll learn more details about credit worthiness, credit scores, and credit reporting, and how you as a consumer can most effectively manage your credit. Let's get started. Credit worthiness is generally defined as the extent to which a person or company is considered suitable to receive financial credit, often based on their history of paying money back in the past. Because lenders or others who extend various types of credit don't have a crystal ball and are no longer able to personally know each of their potential customers, they have to rely on some other indicators of that person's reliability. After all, if they lend you money, it is a loss for them if you don't pay it back. Computerization of financial records has allowed lenders to pool information on their customers and to check customers against that data pool when deciding if they are credit worthy before they determine whether they'll extend credit, and if so, what the terms of that credit will be. If a customer is less credit worthy, they may still get a loan, but may be charged a higher interest rate to offset the risk that they may fail to repay the debt. Before we go any further, it might be helpful to clarify a couple of terms we've used in this lesson. Creditors can make loans or extend credit to consumers. The concepts are similar, and in fact, when a lender agrees to give you a loan, they are actually extending credit. But you'll sometimes hear these terms used for different purposes. Typically, when someone makes a loan or loans money to a customer, they are doing so for a set amount and often for a very specific purpose. For example, you may need $100,000 to buy a home. If a lender agrees to provide that money to you, they will take steps to ensure it is used for the purpose it was intended for, and that $100,000 is all they will lend in that transaction. There is not an opportunity to simply add more to the loan. This is known as an installment loan. You make payments in a predetermined number of installments over time, and when the principal and interest are paid off, the loan is closed. When we talk about extending credit, while that is a broad term for all types of lending, it may often mean what is called a line of credit, and this is best demonstrated by thinking about credit cards. If you apply for a MasterCard and are approved for an account, you will be told what your credit limit is. If you have a $1,000 credit limit, that means that the creditor is extending credit to you up to $1,000. You are not obligated to use any or all of that, but you also cannot use more than that. So you may choose to charge only $100, which would reduce your available credit to $900. But when you pay off that $100 and any accompanying interest, then your balance would be zero, and your available credit would once again be $1,000. And in the case of a credit card, the purpose for which you plan to use the money need not be specified when you apply for the card or when you use it. If you have $1,000 available on your credit limit, the card issuer does not care if you buy 900 Big Gulps from 7-Eleven, pay for your books for school, or get one really nice phone, as long as you pay it back. This type of credit is known as revolving credit because your available credit changes over time depending on your current balance. Another way to think of these is in terms of something called a home equity loan or line of credit. We'll talk more about home equity in an upcoming lesson. But if your home is worth more than you still owe the bank for it, you have something called equity, and you may decide to tap into that equity or value by, say, remodeling your kitchen. You could get a home equity loan for the amount you think you'll need, perhaps $20,000. Use the money to do the work, and know that when you start the loan, you know exactly how long you'll be paying and how much you'll be paying each month until that $20,000 is paid off. That is an installment loan. Or you could get something called a home equity line of credit. The bank may say you can use up to $20,000, but you only use that in small increments as needed to buy the equipment or the services to remodel the kitchen. You may end up only spending $17,000 on your remodel, so you're only paying on the amount that you needed. But as you pay it down, you make more credit available. So if you suddenly realize you need to redo a shower as well, You could tap back into that line of credit, which would make both the balance and the monthly payments change, similar to a credit card. So if you go into a local car dealer today and decide to purchase a new vehicle, and you have a $2,000 down payment that you want to put toward a $20,000 car, you'll obviously need to finance the remaining $18,000, which means that someone will need to extend credit to you so that you can take the car today and begin driving it while you pay the remaining $18,000 of that principal balance off over a period of time. But the car dealer has never met you, nor have the banks that they work with. So why should she or any lender give you a car that you've only paid for 10% of? If you're able to buy the car in this scenario, it will be because someone pulled your credit report and deemed you to be reasonably likely to repay the loan based on your past history. You may be saying, wait a minute, there's a file on me somewhere and anyone can just look at it anytime? Well, yes and no. Nearly every adult American has a credit file, and if they don't have one as a young adult, they will begin building one when they begin making financial transactions in their own name, including bank accounts, credit cards, car loans, and apartment leases. But your file is not readily available to anyone anytime. You have to give them permission to pull or consult the file, and you do this in the paperwork that you sign when you ask for a lender to make a loan or extend credit to you. Once you authorize a lender to check your credit history, they will do so to see what your history of managing credit is like and decide if they want to loan money to you. If they do, in turn, they add information to your credit file by reporting that you have this new account and then reporting regularly, even on a monthly basis, whether you are in fact paying your debt as agreed. This in turn continues to build your credit file. But where is the file? Who has it? Credit bureaus are the main sources of information, and they share your data with authorized parties who subscribe to or pay for their services. There are 3 main bureaus in the United States, and not every account you have is reported to all 3, but between them they're likely to have access to every piece of financial data about you. If you have an auto loan and a credit card and a student loan, the auto lender may be reporting to Bureau A, the credit bureau card may be reporting to Bureaus A and B, and the student loan servicer may report to Bureaus B and C. No one bureau has all the information, but over time as you build your own credit history, each bureau is able to build a fairly complete picture of your financial past and behaviors. Now that you know you have a credit report, you may be wondering what's on it. For many years, consumers did not have ready access to their own credit reports unless they were denied credit by a prospective lender. But in 1970, the government passed the Fair Credit Reporting Act, which governs how credit bureaus can collect and share consumer information. The law also allows every consumer one free copy of his or her credit reports every 12 months from each of the 3 major bureaus and provides a centralized request form for those reports. In our end of lesson activities, you'll learn how to get and review your own credit report. And it's especially important that you do review that report regularly. You have a right to dispute inaccurate information and to ensure that information is removed when it should be. For example, if you had a period of time when you were unemployed and made late or less than minimum payments on your credit card for a few months, that information was almost certainly added to your credit report and is negatively impacting other credit applications you may make. But that information can only stay on your report for 7 years. So if it's still on there from 8 years ago, you can request that it be removed. You may also discover identity theft if there are any accounts you did not open that are in fact under your name. Knowing that information can stay on your report for 7 years, and for up to 10 years in the case of a bankruptcy, you can see that it is important to pay bills and loans on time and in full to ensure that a single missed payment doesn't impact you for years to come. But did you know that employers may also request your permission to access your credit file? Some employers consider that part of a background check and may feel that your credit history is an accurate predictor of the type of employee you'll be, whether you'll be trustworthy and reliable when working for them. Of course, you must give your permission to anyone who wishes to access your credit history, so read carefully when you sign forms, but also know that if you should refuse to grant that permission, lenders will simply not consider you for a loan or credit and employers may refuse to offer you a job or proceed with the interview process. That choice is yours, but there are repercussions. The best solution is understanding how credit works and doing your best to keep your credit history as favorable as possible. Not every lender is examining your full credit report in detail, and as you continue to build credit, the report can be many pages. Considering you have 3 reports, it doesn't make sense for all lenders to review every detail of each report. Especially in cases where you're applying for credit and receiving an instant decision, they are likely not consulting the full report, but instead, they're probably looking at your credit score. These scores summarize your credit risk in a single number based on a snapshot of a credit report at a moment in time. And lenders can buy access to that score when they're deciding on whether to offer you credit. Who do they buy it from? 90% of lenders use what is called the FICO score, which is created by a company called the Fair Isaac Corporation. FICO looks at your credit reports, compares them to millions of others, and uses that to determine your aggregated risk and assign it a number. These numbers range from 300 to 850 on what's called the base FICO score. And while there's no hard and fast rule on what is a good or bad score, lenders do have their own strategies to determine how they consider those scores and who they'll loan money to. For example, you may be approved for a car loan with a score of 580, but it's very challenging to get a home loan if your score is under 600 because the size of the loan represents a larger risk for the lender. There are other FICO scores besides the base score for specialized purposes as well. Insurance companies may consult a different version tailored to their business that assesses your risk differently. But the base FICO score is the one most widely used in credit decisions. And that can vary from one credit bureau to another because not all lenders report to all of the bureaus at the same frequency. Because they do look at the big picture, it's likely that your scores from the 3 bureaus will fall into a close range on the larger possible scale. In the previous video and on the last slide, we talked about lenders each having their own strategy for assessing risk and determining if they would loan you money or extend credit to you. In the example here, you'll see that 2 individuals had very different credit scores. Both actually received the home loan, but as a result of a lower credit score, consumer B is paying a much higher interest rate, which will result in a significantly larger total cost over time to be able to borrow that money. What factors go into a credit score, and why might consumer A be considered a better risk for credit than consumer B? Let's examine the major factors. It can be scary to think that your credit history and a single number like your credit score could keep you from getting a job, an apartment, or a car, or could mean that you have to pay significantly more for a home loan than someone who lives in the same town, holds the same job, and makes the same salary you do. But your credit score isn't something to be afraid of because you are in control of all 5 of the major categories that go into that score. The largest single factor in your payment history. Do you make your payments, and do you make them on time? Credit scores factor in the frequency, recency, and severity of missed payments. While the negative impact of a missed payment can legally affect your credit score for up to 7 years, the impact of it will lessen over time as long as you continue to make on-time payments. The easiest way to maintain good credit is to make your payments and to make them before they're due. Use automatic bill pay or include reminders in your budgeting system to ensure no payment is missed or late, and that is 35% of the battle. Credit utilization is the second largest factor and makes up 30% of your score. How much credit do you have available, and how much of that do you actually use at any given time? If you have, for example, 10 credit cards with a total limit of $10,000, and you have balances totaling $5,000, your credit utilization is at 50%. Experts recommend that you keep your utilization below 10% to have a maximum positive impact on your credit score. The length of your credit history is 15% of your score. While a young consumer with several new accounts may have an outstanding payment and utilization record, he or she has not yet proven that they will manage credit consistently well over time. However, it is possible to still have a very good credit score even if your history is fairly new. Having a lengthier credit history also means that it may not always be to your benefit to close old accounts you're no longer using. If you have one credit card that's 5 years old and the rest are less than a year old, that one card may be providing a boost to your score because it's an older account. 10% of your score is made up by how much new credit you have. While having newly opened accounts may seem like a good thing, given that creditors were willing to grant you credit, too many new accounts could mean that you're on a spending spree or you're in a difficult financial situation and trying to open new accounts to resolve some issue. Each time you apply for an account, even if you aren't approved, it shows up as what's called a hard inquiry or hard pull on your report, which tells other prospective creditors that you're applying for lots of new credit, and that could be a negative. While creditors will entice you with offers of miles or points or 20% off a total purchase today if you apply, and they say, just close the account afterward, you don't need to keep it. That's not a good cycle to get into and could ultimately affect your score. Finally, 10% of your score is determined by your credit mix. Earlier in the lesson, we talked about installment loans and revolving credit. This factor considers whether you have a good mix of different types of credit. A consumer with an auto loan, 2 credit cards, and a student loan would be seen to have a better credit mix than someone who only has credit cards. You know what is included in your credit score, but what about what's not included? There are a few things to be aware of when you think about credit scores. The Federal Trade Commission, the nation's consumer protection agency, is responsible for enforcing the Equal Credit Opportunity Act, which prohibits credit discrimination on the basis of race, color, religion, national origin, sex, marital status, age, or because you may get public assistance. There are some other factors, though, that you might think are in a credit score, but really aren't. Your income, education, profession, and geographic location are, in and of themselves, not considered part of your credit score. A consumer with an annual salary of $300,000 could have a lower credit score than one who makes only $30,000 per year because the credit score is based on what kinds of credit you get and maintain and how you manage what you have. What can you do to establish and maintain good credit? First, be an informed consumer. When you sign up for a loan or credit card, know the terms and be sure you're prepared to meet them and to make your payments on time. Don't borrow more than you can repay and continue working to grow your emergency fund that we discussed in the budgeting lesson so that a temporary setback or crisis won't mean that you have late or missed loan or credit card payments on your history. Be very careful of signing any loan or credit documents for or with anyone else. Co-signing a loan means that you are accepting responsibility for that if the other party fails to pay, and it would impact negatively your credit history and score. And remember that all kinds of accounts are reported. Student loan payments, rent payments, and more will be included in your overall credit history. Know the factors that make up the credit score and be mindful of them when you make financial choices. For example, while it's a worst-case scenario, if you were in a dire financial situation and had exhausted your savings, you may have to decide if a payment would be late or missed. Knowing how important your payment history is, it would be far better to have a single missed payment than 3, and easier to recover from. Don't be tempted to open accounts just for a quick discount. If you don't need the account and won't really gain any financial benefit long-term from having it, don't open it. Finally, view your credit report regularly and look it over for negative, inaccurate, or outdated information. While negative information may be there legitimately, it's important for you to be aware of it so that you're likely to make choices accordingly if applying for any new credit, and so that you can ask if it be removed if it's been on there too long. In the next activity, you'll be asked to consider some scenarios in terms of credit card repayment and the impact that that can have overall on the total amount that you pay. And then in the closing the loop activity at the end of this lesson, you'll have an opportunity to download and review either your own credit report or a sample report so that you know what to look for.